looking at the performance of the NSE
Hi.
30 this year, it seems to have underperformed emerging markets in general. What do you think is going to get the NSE Nigerian stocks back on the radar of investors who want to get exposure to emerging markets?
Morning, Samantha. Well, I think that the point is that there is a need for surplus liquidity to find extra yield, but the preference will, in the first instance, be I think for larger and more liquid emerging markets. So I think that is what has driven the underperformance versus frontier markets, and for Nigeria in particular, clearly we've also had some specific issues with respect to the start of the year. Obviously, there was some civil disquiet in the early part of January with the strikes, and also some of the terrorist activity, which also added a layer of uncertainty to the sentiment surrounding the market.
Yeah.
As far as what will get the stocks back on the radar, I think that we really need to see, one, a reduction in interest rates that will sort of stimulate interest locally, and also I think the international investor base needs to feel that the currency has a basis for long-term stability, and that is driven by the execution of policy. So the Sovereign Wealth Fund has been signed into law since May last year, but we still haven't seen it up and running. And I think that this would be a significant step forward in terms of internationals gaining confidence, because even if there is saving resuming in the excess crude account, it's quite clear that that whole framework has been somewhat undermined, and the drawdowns on that excess crude account can't really be transparently explained. So the Sovereign Wealth Fund, I think, is very important.
Yeah, as you say, that implementation of these economic reforms is so key, for a key signal for the international community. Do you get a sense that the government is shifting and is moving quickly enough to start implementing these reforms and increase the confidence that it has from international investors?
Well, I think that government reforms in developing markets are never quick, and I think that there is a general acceptance of that. I think that the events of January will have acted as some sort of catalyst or reminder for that which the government intends to do needs to be done, concertedly and as quickly as possible. I think that the events of January have added additional pressure to the government. The key really is whether the pressure is sustained by both Labour and civil society.
Yeah.
The commentary in the press, the national discourse needs to maintain that pressure on government to ensure that the reforms are executed in a timely fashion.
Well, with the markets, of course, still on the back foot, well, pretty much on the back foot if you look at it on a relative basis, what would your recommendations be with regards to position taking on sectors right now, especially in the light of the fact that, as you say, we don't have an outlook for interest rates coming down anytime soon?
Well, I think that, to be honest with you, for local investors, I think that they are still struggling, certainly say, for example, the pension funds, to put their marginal money, the new money that's coming into the equities market. But for those that are able to satisfy their sort of trustees that it is prudent for a pension fund to direct some of its resources to a longer term investment strategy, I think that they should be looking at the banks for sure. As we highlighted in our note published today, that the sector is really in a far stronger position than it was 3 years ago, and the valuations really do not reflect that. I mean, in terms of the performance, stock market performance relative to the NSE versus EPS growth, the banking sector is almost exclusively at a complete divergence. Whereas we've seen stocks like the consumer stocks that haven't necessarily delivered the EPS growth perform strongly, largely because a lot of them are subsidiaries of internationals, and investors have taken some comfort from that. So we would recommend tier 1 banks. We are favouring First Bank, Zenith Bank and GT at this time, both for a combination of potential upside and high dividend yields, as well as the fact that they are resiliently positioned within their markets. Those names offer between 60 and 100% total return by our estimates.
I mean, yeah,
and for investors that are looking to stay with...
Yeah. Just staying in the banking sector.
For investors that are looking to stay with names.
Yeah.
Yeah. Okay, go on.
No, I was just saying, looking at the banking sector, you're looking at First Bank with upside of up to 100% right now. Just give us your views on the health of the banking sector with regards to asset quality and the bad loans that are still in circulation.
Well, I think, again, referencing sort of first quarter 2009 to today, we're in a very different place. The NPL ratios, I mean, at the end of 2009, the highest NPL for the banks under our coverage was 40%. And that is now 14% we're expecting for this year for Fidelity, with the tier one banks sort of looking to be comfortably below 5% by the end of this year, and the average for the sector clearly migrating downwards. Provisions in 2010 for the names that we cover was around 266 billion, and we expect that to be about 128 billion this year. So, asset quality is improving, provisioning is coming down, the cost of risk is falling basically, and we expect that to continue. And we think the initiatives that are ongoing within the sector to make it more relevant to the real sector will help to underpin sustainable earnings over the medium term, which is key. So banks will begin to grow their ROE more slowly, but on a sustainable basis.
Let's move back to consumer names. As you say, many of these have multinational backing, and consumers and investors found comfort in that. There are divergent views in terms of which stocks you would get exposure to if you are looking from a more long-term perspective. Short-term margin squeeze is a big concern right now. Which are your favorite stocks in that sector?
Interestingly, we only have 6 high conviction names as a whole, and the only consumer name we have in that space is UAC. The reason being that they are less exposed to imported inputs, and we think that therefore they would be under less pressure if we saw any kind of further weakening in the currency. So in terms of sort of medium-term strategic plans, the sort of tying with Tiger Brands will begin to bear fruit over the medium term, and I think that we believe that the near-term pressures that are broadly common to the sector are less of an issue for UAC, and I don't think that EPS growth this year is really going to be able to justify strong performance for the consumer sector for 2012.